Good morning, everyone. Welcome back to these videos for 2017, which I do every Sunday morning to give you a pretty good snapshot of what's going on around the world in stocks and commodities and to a lesser extent bonds and currencies. And it has really been a ripping start to 2017. And at this point in time, it is really hard to be bearish on the market. The US market in particular has run pretty hard and is overbought, so there may be a short-term pullback. But if you take a bit of a wider view, you've really got to be on the bullish side of the road, that's for sure. So let's take a look at what's transpired and where we sit currently. So just as a general backdrop, there's been an enormous surge in enthusiasm in the States at a retail level, at a corporate level, and to a degree, I think there's some enthusiasm back in some of the government areas as well that maybe the US can pull itself out of this malaise that it's been in during the 8 years of Obama, and so the population is generally looking forward to a pro-growth, less regulated environment for business, which is going to be a real positive. And hopefully we can get something similar happening in Australia. But I'm a bit despondent about the Australian political system, I must say. Now, what's going on in America is being spurred by the prospect of massive tax cuts. The American corporate tax level is 35%, which is one of the highest in the world. And Trump is talking about bringing that down to 15. I've got my doubts whether he'll get it down to that level. But even if he could bring it down to 20 to 25, that plus the added spending on infrastructure is just going to have a massive impact, massively positive impact on the American economy. Now, a great deal of that has already been priced in by the market. We've seen an enormous surge in US financial stocks, aerospace and defense stocks, construction, and quite a lot in the Russell 2000 stocks. But at this point in time, nothing has been approved. Now, it's highly likely that Trump will be able to get through certainly a decent percentage of what he wants to do, and that'll be positive. But gee, a lot has been priced in. So there is some short-term risk if he can't deliver, and that won't really become apparent until probably March or April, then there is some downside potential in the market. But I've got to say that higher prices are still likely, but you would be very unwise not to factor in some heightened volatility. So I'm very bullish on 2017, but also I do expect that we will see periodically, every few months or a couple of times in each half year, we're likely to see something that's going to trigger some stock market volatility. So the real question that I would ask you to consider is whether your strategies, but B, more importantly, your mental resolve is up to the task and the opportunities that are ahead of us. And that's where it always breaks down for traders and investors. It's whether your mental resolve can stay the course. And that's the big challenge for 2017, I believe. So if you're expecting plain sailing, and whilst I expect to see indices higher throughout the year, it won't be plain sailing, that's for sure, and therefore you might find yourself scrambling if you're not totally clear about what you're doing. Now, a market top requires a couple of things, and I've touched on this repeatedly over the years. Particularly in the last 5 or 6 years when people have been continually trying to call a top in the market. You require heavy investor participation. We still don't have that. And you need a level of confidence that's bordering on euphoria, and we certainly have not had that and still don't. Now, it could well be that in the first half of 2017 that we see a flood of money back into the market, and that we see a level of confidence that's starting to get up to euphoria. If that occurs, then I'll change my position on the possibility of a market top. But at the moment, we don't have either of those things, and so therefore a market top is basically a non-event. It's not going to happen because it does require those two things almost by definition. So I remain very positive on particularly the US market. Now, US stock valuations in some of these sectors that have really surged are potentially an issue. So earnings growth over the next 2 quarters, and we'll see earnings numbers start to filter through soon. But that certainly is going to be a critical issue. Another critical issue is going to be the speed of interest rate rises. If the Fed does raise rates 3 or 4 times throughout 2017, then that puts increasing pressure on the stock market to perform. However, I doubt that's going to happen. I'm expecting probably 2 interest rate rises, which would get the US back to 1%. I think that's the more likely outcome for 2017. And I think the stock market, if the earnings come through, and I expect that they will, given the Trump stimulus and the tax cuts, then I think we'll be fine. And it could well be that the energy sector, and we've seen energy stocks doing very well in the last 3 or 4 months, it could well be that the energy sector could be the catalyst to continue this run higher in general stocks, because it's been the earnings decline, the significant earnings decline in the energy sector that has really filtered through to the whole market. So if we're about to see a surge in energy profitability, which is quite possible because energy is now up from $30 to the mid 50s. So I expect to see a big turnaround in the profitability of energy stocks. Then that could be a real positive for the whole market. Turning to the actual market itself, it was a shortened week, but the S&P still managed a gain of 39 points and closed at a new all-time high. Now, which US sectors? Domestically focused sectors, I think, in preference to multinationals, because we've still got a pretty strong dollar and that is having some impact on those. So I think the domestically focused stocks are probably a preference. And in particular, the sectors finance, oil and gas, technology, resources, particularly around copper, and also precious metals are starting to look better. I'll deal with that separately. Also aerospace and defence, with the intended spending in that area. And we're also starting to see some very positive moves from uranium, and stocks trying to price in a better set of fundamentals in 2018 and 19. So there's certainly some positives there. So let's take a look at the US stocks. This is the S&P index. First of all, let's take a big picture look. This is the monthly chart. So back here we've got 2009. So there's the depths of the GFC, and the S&P was down around the 700 mark. Now we're 3 times higher than that in that period since the GFC, and you can see that it's tracking along a pretty strong trend. And I've put a bit of an Elliott wave structure to this. I'm not, as I've mentioned many times before, I'm not an Elliott wave devotee, but there is an element of validity to Elliott wave because it does reflect human psychology. So we've had legs one up, 2 down, which was the correction we saw in 2011. The longest run, the third leg, took us up into the early part of 2015. We then got a bit of a choppy washing machine sideways action, which is typical of leg 4. And now we're embarked on leg 5. Now, wave 5s can be short and not go to very much of a new high, or they can be longer. They don't tend to go as far as wave 3s, but they can tend to still give us a decent run. And I think it's possible that 2,500 points, maybe even a little better, is certainly from a valuation point of view possible, and I'll come back to that. So certainly we've got a very, very positive trend in the US. This is the actual daily chart. and you can see we had a strong run up from just the lows post the US election, and a little bit of a pullback in between Christmas and New Year, and then another nice surge. So things looking pretty good. Let's look at the NASDAQ. New all-time highs on the NASDAQ broken out in the last couple of days. And if we look at the Russell 2000, you can see also basically trading at all-time highs on the Russell. So the small caps doing very well. And you can see the extraordinary surge in the Russell 2000 post the US election. That chart was looking very, very shaky indeed until we saw the huge turnaround post the election. Just getting a little bit of stabilization now, and I wouldn't mind seeing it perhaps pull back a little bit to the lower 1300s, but certainly that's looking extremely positive. Just while I'm here, let's look at the US dollar index because it is critical to so many things. If we pan back, you can see we've had a significant breakout. So we're in this range between 92.5 and roughly 100. That really started formation in 2015, so it's been running now for 2 years. We've got a strong breakout which occurred in November post the US election. We got a retest. We then had another surge higher to overbought again. We're getting a bit more of a pullback. I do note, however, that we've got some divergence here on the US dollar, so we may actually get a pullback into the range. You can see that we've formed higher highs on the actual dollar price, but the speed of that uptrend, or the momentum behind that uptrend, is starting to wane. You can see here on the RSI, we're forming lower highs and lower lows. So the upward momentum is definitely waning. Whether we come back and just retest this 100 level or whether we actually pull back into the range, we'll have to wait and see. But certainly that will influence commodity prices, and I think there's a chance that we've seen the highs in the US dollar for the short to medium term. So that'll be helpful for commodity prices. Turning now to Aussie stocks, the Aussie dollar is holding around 73, got down to about 71.6 when at the peak of the US dollar. So we might see a little bit of more uptick in the Australian dollar if the US dollar does come off. But the longer term, we're still probably looking at low 70s or even perhaps sub 70s. But it will be certainly dependent to a degree on iron ore prices, coal prices, and just generally what other currencies are doing around the world. Now, the ASX 200 index surged higher by 90 points on the week, led by banks and energy. But as you know, I think it's a pretty meaningless sort of index, the ASX 200. Much of our market is not doing anything at all, and I'm really having a hard time getting excited about the Australian market. There are isolated small cap opportunities, but you've got to be really clear about what it is you're waiting for. Wait for the dip and then buy the dip with a degree of confidence, but you've got to be extremely selective. And you certainly want to stay away from any stock which is carrying a significant PE ratio above 20, because we've just seen the absolute carnage in the last 6 months that's occurred with any of these stocks that have missed expectations, with stocks like Vocus and Bellamy's and even the big healthcare stocks like CSL. And CSL was down 20% at one stage. These stocks are being just treated absolutely brutally. Certex is another high PE stock that was hit. There's been a huge number of them. So I'm really quite defensive in attitude about the Australian market. Let's just take a look at that index. So this is the ASX 200. So you can see we did have resistance at 5,600, which had been in play for quite some time, and we've broken out of that just in the last couple of weeks, and the index is probably getting a little bit overbought in the shorter term. Now let's turn to precious metals. There's no question it was the most out of favour sector anywhere in the world in the fourth quarter. We had an incredible start to the first 6 months of 2016 for precious metals. It was the strongest and fastest move that we've ever seen in the history of the sector. So no surprise to see a pullback in the second half. However, that pullback, it really did become a bit of a perfect storm. We had Brexit, then we had the Trump situation, and we had the Fed raising interest rates, and precious metals prices just got absolutely belted in the futures market because stop losses got triggered, and that just created a cascade of selling. However, just in the last week or so, stocks in the sector have started to surge against very, very bearish sentiment. And that's a real positive, and it's the same thing that we saw at the start of 2016. But if we look at 2016 as a whole, the precious metals sector still gained 65%. So I'm talking about the stocks here. So as a whole, the GDX was still up by 65% across the year, even despite the massive selling at the end. And traders are forgetting that precious metals was one of the strongest sectors throughout 2016. Too often people are just looking at really recent history and not taking the bigger picture into account. The fundamental and value setup, I believe, is the same now as it was in early January 2016, and we saw the extraordinary surge. The GDX was up 186% in the first 6 months of 2016, and I believe all the fundamentals are in place for something similar to occur. Now, I'm not saying it's going to play out exactly the same way, because it probably won't, but there is certain. This is the contrarian time to be starting to rebuild some exposure into the sector. Now, please do not go out and just ramp it up suddenly, because often markets, when they come off lows, you get a retest of the lows, and we still could be in a situation where we get a few weeks or a few months of mucking around at these lower levels. So with stocks, precious metal stocks in the States up by more than 10% in just the last week, you don't want to go stampeding back into this sector. Gold was up 2% on the week. Silver was up 3.5%, but the leading stock indices and the leading stocks were up by over 10% on the week. So a very, very strong week, which was very pleasing. So let's take a look at the precious metals sector. So let's look at silver. So quite a nice rise there for silver, and does whilst we really need to get above about 1750 to form a higher high, we certainly are seeing stocks leading the way, and that's what you want to see. You want to see the precious metal stocks moving before the actual underlying metals really start to move. And this is gold, so we've seen quite a nice move higher. We got down to about 1120 on gold, and then on Thursday we peaked at 1186. That's quite a strong move. Now, as I said, possible we could get a bit of a retest here, or a bit of a partial retrace of this move. So certainly don't go too hard into the sector at the moment. But if we look at GDX, you can see we have formed new highs. So it's been quite a positive move at this stage, and accompanied by some pretty good volumes. I'll just go back to the gold chart, and I just want to point something out here on the weekly chart. Now we've had some selling. We've certainly had some selling at the end of the year. So if we just look at year end in gold for 2013, you can see that we had selling down into the end of 2013. We then got a strong rally. We then had selling down into the end of, where are we? December. There we go. We had selling down into the end of 2014, and then we got a decent rally, but formed lower highs. We then got selling again down into the end of 2015. So there we go there. There's the 25th of December. So all the time forming lower lows and lower highs. But each time coming out of the end of year selling, we got strong rises. We got a strong rise there, another strong rise here, but lower lows. But look at this time. This time we formed a much higher high coming out off those lows. So that's the first positive. The second positive is at this point in time, the selling into 2016 did not form a lower low. So 2013 to 14 to 15 formed lower lows. This time we formed a higher low and we've got higher highs. So that's why I'm still positive, medium to longer term on the precious metals space because the fundamentals and the valuations support it. These companies are highly profitable at these levels, and the technicals are starting to look a lot better as well. So I remain pretty positive on the sector. Turning to other commodities, copper has just been holding around $2.50, but there is a very positive outlook in stock prices. So if you look at some of the major, if you look at BHP, you look at Rio, you look at Freeport McMoran, you look at Teck Resources, so the major copper producers are certainly looking extremely positive from a price chart point of view. Crude oil is sort of broken out. It hasn't really absolutely confirmed it. I think I'd rather see a move above 55 to feel a little bit more certain about crude oil, but it's certainly looking good. So to me, the breakout is almost confirmed. It's possible we could have one last dip into the trading range. But again, energy stocks leading the way. Energy stocks looking even better than oil is. Copper stocks looking better than copper is. Precious metal stocks looking better than the underlying stocks. So these trends are pretty much undeniable. There's the spot copper chart. So just to wrap it up, and I just keep reinforcing this point every week, strategy and process is absolutely vital. You've got to be really clear about what you're doing. Most people aren't. I think you can buy the dips in the US market with some degree of confidence. They're a bit overbought at the moment, so just be careful until we get that little bit of a dip. Place your emphasis on sectors that have been out of favour and are turning higher, because that minimises the downside risk if we do get a general market correction. And there's any number of things that could trigger that. So I certainly wouldn't be chasing the sectors that have been really in favour. Just look and focus more on the dips. As far as the Australian market goes, I struggle really to feel confident about the Australian market. I really do, because of the response that we're seeing, the ridiculously outsized response we're seeing to sometimes quite minor misses. As far as the US market goes, if all the ducks line up, I believe S&P above 2,500 is possible during 2017. I know might be a big call, but look, if Trump can get these tax cuts through, I've seen estimates that have been done by some of the major analytical houses that would provide a boost to corporate earnings of around 10%. If you factor in a 10% rise in corporate earnings and you apply the current PE multiple of the market, then you get around 2,500 points on the S&P. So it would only be consistent with with what is quite likely to occur. Significant downside in the US market looks unlikely at this stage. Right at the start of this presentation, I indicated that for a significant market top, you have to have a high level of participation in the market. We don't have that. You have to have a sentiment bordering euphoria. We're not even remotely close to that. So I think any corrections in the US are an opportunity to buy, and I'm really pretty bullish and pretty excited about the opportunities that 2017 offer. So that's it for this week. There's my contact detail for non-members if anyone would like to communicate with me about the market. There's some very exciting things unfolding, which I'll be unveiling to members in the coming weeks. And yeah, look forward to this year with a great deal of enthusiasm. Cheers.